do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen.
The Fed Chair Jay Powell there speaking after that half-point rate cut. You're watching the China Show. I'm Yvonne with Stephen Engle. Our top stories this morning. The Fed's outsized rate cut boosting Asian stocks. Traders ramping up bets on more easing, even as Jay Powell stresses this is not the new normal. Also ahead, U.S. officials in Beijing for fresh talks on economic tensions while China's trade minister tackles EV tariffs in Europe. And Israel signaling a new phase in the Middle East conflict after a second wave of device explosions in Lebanon. Well, was it dovish? Was it hawkish? Certainly, that's just what we're looking at here right now. The market reaction post-Fed decision and then what we saw after that press briefing certainly did see a bit of whipsaw when it comes to the S&P, gold, both of which hit those all-time highs and then retreated during that press briefing when Jay Powell, as you heard just there, say, look, don't get used to us. It's not a new pace. Rates are not on that reset path here right now. Two-year yields also reversing there during that, and the dollar also. There you go, seeing that very much expressed in dollar yen here this morning. So certainly that's the sort of initial reaction here right now. In Asia, though, we're still treading pretty slightly higher here, and really it's the Nikkei that is benefiting from all this because of that reversal in the yen. So we are seeing quite a bit of weakness in the yen here right now. That's boosting the Nikkei 225 of 2% gains. Taiwan just coming online, slightly catching a bit here, but it's a mixed picture overall. U.S. futures, though, are punching slightly higher here. The dollar's catching a slight bit. Treasury yields, though, so that's where I think markets are still a little bit confused of why we're seeing bonds falter after a 50 basis point cut, which was not consensus, right? We're actually seeing the yield curve shift higher across the board. And I think it's the fact that we had so much uncertainty about where rates are really going to land. I think that's what's leading the bond market to really scratch their heads right now. We're seeing two-year yields at about 2 basis points higher. The 10 years about 1 basis point, but we did see that steepening overnight as well. You're seeing that across sovereign bond markets here this morning where bonds are faltering. Brent is also snapping out of 2 days of gains. Gold futures, there we go. We briefly touched that 2,600 level or more, and now we're back to about 25.80 this morning. You take a look at how the approach to the open in China is going to feel like. So, yes, we come back from Hong Kong after being shut for 1 day. So Hong Kong, we'll see how they react to that because HKMA, in line with the Fed, also cut rates by 50 basis points as well here this morning. We're watching the property developers very closely to see if there's any sort of reaction there. Futures are slightly to the downside here today. Chinese 10-year yields continue, though, with this rally. 202, we're down about 1 basis points, and 710, just some slight weakness here in the currency. I want to bring in my anchor buddy, Steve, now. What a day.
We knew it was coming.
Yeah.
We just didn't know what the result was going to be. Was it hawkishly dovish or dovishly hawkish? Well, we have to put that question to our guest coming up in just a minute. Let's hear from Fed Chair Jerome Powell first, speaking after the decision.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. A broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
And perhaps what really did get the market confused was really what we saw in the dots here right now. Yeah, so outsized move cut. Let's go big first. But then again, you're seeing only a narrow majority of policymakers that are expecting another 50 basis point cut in the next two policy meetings this year. That's far short from what the markets are pricing in. They're still thinking about, 70 basis points of cuts as well. So there's still a bit of adjustment there. And of course, we had that rare dissent.
Right. I mean, the first time the governor has dissented since 2005, Michelle Bowman, we're talking about essentially saying that 25 basis points would have been her preference, saying that inflation is still uncomfortably above the Fed target rate of 2%. So, again, that dissension, if you will, causing a little bit of uncertainty as far as how to read this.
Yeah, and we're certainly going to see how this all looks at this, right? Because are we getting closer to a softer landing now? Let's bring that question to Helen Ju, Managing Director and CIO at NF Trinity. What did you make of this overall statement and what we heard from the presser as well?
Well, I think Steve is right. It's a mixed message, right? If I have to pick one, I would say probably dovishly hawkish. And that's what the market seems to be saying this morning as well, right? On one hand, we got the 50 basis points that takes off the pressures of being told that, you're behind the curve. But on the other hand, everything else he said is more along the lines of don't expect this to be the new norm. The economy is actually still quite okay, and we're just going to have to, continue to watch, right? So I think that it's right for the market to see the yield curve move up a little bit. And I think actually the overall market pricing for the Fed funds rates is probably a little bit too sanguine at the moment. And I think the dot plot is probably closer to the reality versus where the market is at the moment.
So 2 more meetings the rest of this year. Can we predict what's going to happen? We did a big move this time, maybe catch up from July when they didn't move. What's in the cards for the next couple of meetings?
I would say probably just one rate cut each, but I think everything's actually now data dependent and not necessarily Fed dependent, right? I mean, part of the reason why the market's doing better this week is not just because of the 50 basis point rate cut, but it's actually because of the fact that the retail sales data earlier in the week was pretty okay. So that actually alleviated some of the fears that people had. So I think moving forward, the most important thing is not really what the rate cuts are going to look like, but what drives the Fed decision, which is growth, right? So the most important thing is the jobs market. Basically, if you look at the ADP, you look at the unemployment, you look at the NFP, if those numbers don't look good, then it doesn't really matter as much what the Fed does. People are going to sell the market. If those numbers look good, then, probably 25 basis points per meeting is the default.
How do you think this is going to go down, though, for the Fed? Are they being, I guess, prescient and being front-loading this easing cycle to prevent any sort of weakness in the economy and the labor market? Or is this going to be seen longer term as premature to start this easing cycle and declaring victory on inflation?
I think the Fed is not so worried about inflation at the moment. If you actually look at, the dot plot, it's actually revised down inflation expectations and revised up unemployment expectations versus the June dot plot. Plus, if you actually look at what's been happening in the commodities market and, global PMIs, et cetera, you would be, probably not as concerned about inflation as you were 3 months ago as well. Would people think this is more front-loading? I think they're more like thinking that, we want to avoid the risk of being too late, right? So it's not so much front loading. It's really just trying to catch up to maybe where the expectations were earlier before all the jobs numbers started to crash in the August and September readings.
Yeah.
So
or maybe an acknowledgement that they probably could have cut in July, too.
Yeah, they probably could have, right? They probably could have. What does this mean for bond traders? I mean, they're scratching their head saying which end of the curve is going which way.
Yeah, I think in the near term, we're less positive on treasuries and on bonds. We actually think that probably the expectation about rate cuts is a little bit too aggressive in the near term. In fact, across the curve, right? In fact, I think if you look at financial conditions even before this rate cut, because of the fact that credit spreads have been so thin and because the equity market performance has been very strong, et cetera, and the 10-year has come down quite a bit, actually financial conditions are pretty loose, right? They're back to very loose levels aside from 2021 trough levels. So we actually don't think that necessarily there needs to be so many rate cuts unless there's a total crash in the market in the growth data, in which case then whatever rate cuts is not necessarily going to be enough to make people turn positive. I think in terms of treasuries, we think that it doesn't have great value at the moment, and we think in terms of bonds overall, because the credit spread is not reflecting meaningful recessionary fears, it's less attractive at the moment as well.
There might be some out there that are tempted to chase stocks still right now. Is that still the recommendation from you?
I would say upside versus downside, I would say risk reward in the U.S. is not great. The reason is because let's say the data continues to be fairly buoyant, maybe, given the positioning, the valuation, the expectation is quite high already, and all the sectors that people like have performed pretty well. I would say maybe the upside is a few percentage points between now and year end, and that's probably going to hinge more on the election rather than on some of these other things like the Fed. But on the downside, if you do get really poor data for another 1 or 2 months, that's going to break the market confidence a lot. And you could have, some brokers are saying as much as 5 or 10% or even more downside. So we think the U.S. equities are probably still a bit precarious.
How significant is the dissension from Michelle Bowman?
I think one voice is not necessarily going to move things, but I think she makes a logical argument, right? We don't necessarily have a huge amount of pressure in terms of overall growth trends, and inflation on an absolute basis is still not at a low level relative to history and relative to where their target is. So I think it's a good point. And indeed, up until a few days ago when the bad jobs data came in again late Friday, a lot of other people were actually also looking at 25 basis points instead of 50. So, these things shift very, very quickly.
You mentioned maybe the U.S. is more, I guess you say risk reward may not be as balanced as now, but do you look elsewhere then? Is the EM story looking more appealing to you now?
Exactly. I think if we do get a decent soft landing roadmap, which is, I think, the right assumption for the moment, I do think that elsewhere in the world is going to benefit a lot more, right? So if you look at EM, you look at Asia, even, other parts like UK, for example, the growth is okay, but last year and maybe late the year before, there was so much FX pressure that the markets didn't really deliver, and a lot of people didn't see any need to move outside the U.S. It was just U.S. exceptionalism. Yeah. But as the dollar is weakening, as there are signs that the U.S. economy is meaningfully coming off, then I think people get more worried and start to move elsewhere, and also more election uncertainty versus what we had a couple of months ago, right?
We could probably talk a lot about the election, but again, we'll talk about China as well after the break. But I wanted to get your opinion on, with the RBA coming up with this decision, I think Tuesday, Japan also has a decision. Does this at all change the equation for the BOJ or the RBA?
I think it does a little bit, but not so much. I think every country has to look at their own individual situation. I would say for some central banks, it gives them a little bit more room and more flexibility versus if the Fed wasn't moving or even hiking rates, right? That really puts a lot of FX pressure on the central banks that cut and go against the Fed. So if they're cutting as well, if the Fed is cutting, it gives you more flexibility, but it doesn't mean necessarily that you have to do the same thing. And BOJ is such a special circumstance, right? Because they're starting off a completely extreme, starting point in terms of rates versus the rest of the world. So I don't think it's necessarily completely linked to the Fed decision.
So given that is the window starting to close now for them to hike, though? Because we're starting to see this easing cycle.
That's probably part of the reason what we saw, a month and a half ago from the BOJ.
Okay. All right.
All right. Well, we'll have more, of course, with Helen Ju, Managing Director and CIO at NF Trinity. And we are counting down to the open of the trade in Shanghai, Shenzhen, and Hong Kong. Keep it right here. This is Bloomberg.
All right, futures are pretty much flat here this morning, and we're seeing when it comes to what could happen with the Hong Kong reopen. Obviously, we're watching very closely what this means for stocks, whether we get some relief now that we have seen that 50 basis point cut from the Fed. Property developers very much in focus here today. We also got some consumption data that came out from that Mid-Autumn Festival, which actually was pretty upbeat as well. We'll see if the consumer sector, the ailing consumer sector, can get any sort of...
We have another holiday coming up, too.
And a typhoon.
And a typhoon in Shanghai, but a week-long holiday for the National Day as well. So a good barometer for the pulse check on the consumer.
We also got that rent reference rate here this morning, 709.83, pretty much in line with estimates here this morning. In terms of what to watch in your agenda here today, we talk about that Hong Kong market reopen after that holiday. CGB yields, of course, obviously, I think we've been down for about 7 or 8 days already. We'll see if that continues. Some jobless rate numbers coming out of Hong Kong. John Lee's going to have a presser. He's also going to be in Beijing, I should say, not that presser. But we're watching also these talks between China and Europe about when it comes to EV tariffs as well. So the Commerce Minister is going to be over there in the EU. And also U.S. officials are going to be in Beijing. So there's quite a few talks at hand there.
I think they're there today. Jay Shambaugh, he's the Undersecretary of Treasury for International Affairs, leading a delegation that includes Fed officials, by the way, to Beijing there for the Economic Working Group to keep the dialogue going on the economic side of relations between China and the U.S.
Yep. Still with us is Helen Ju, Managing Director and CIO at NF Trinity. We've been talking about just the bearishness overall when it comes to Chinese stocks. Do you see any signs of things looking up?
Well, I think on a cyclical front, things are not getting substantially worse. They're not getting meaningfully better, though. I think on a structural front, people are still waiting for more concrete policy announcements after the third plenum. There were some big picture things talked about over the medium to longer term, and we've started to gradually see some policies, in terms of supporting consumption, in terms of extending the retirement age, but, nothing that really makes people feel like it's going to be immediately evident in the data yet. And I think the most important and one other thing is really the geopolitics geopolitics aspect, right? People are watching the U.S. election. They're worried about the risk of 60% tariffs next year coming out of a potential Trump administration. So these things are probably going to leave things probably still range bound for the foreseeable term.
So it's probably a fool's errand to think that any kind of bazooka stimulus is coming. There have been no indication that it's going to be unleashed, of course. There could be some more rate cuts or help on the mortgage front. What do you think?
Look, I mean, there's been a very large basket of all sorts of policies here already, right? So I don't know what we would call a bazooka, but certainly there's been many combinations of different types of policies, fiscal, monetary, administrative, property related. And, you know, the effect so far is lukewarm. It's helped things from going down a bit further, but it hasn't really made anything recover in a V-shape trend. I think the most important thing is really about the expectation about property price, right?
Yeah.
So that's basically what most people's wealth is actually concentrated on. And so if the expectation on property price is negative, I don't think that rate cuts or mortgage cuts is really going to help that much in terms of the demand. So I think that's the most important policy focus point for the regulators at the moment to think about how to turn that around.
Yeah, I mean, people say, given the valuations, there is some sort of tactical opportunities. What are those tactical opportunities still?
Well, look, I mean, the Chinese markets have been really gruesome over the past years and, has really massively underperformed, especially recently. I would say, relatively speaking, if you look at what's done well this year, it's basically been all the SOEs. So the banks actually haven't been too bad. The telcos have been very strong. The energy stocks, until the recent oil rout, has actually been very, very strong. So probably, relatively speaking, the dividend yield thesis has already played out. What's really been hammered is really internet and consumer. So previously the positioning was relatively higher and the valuation was relatively higher, but all of that has been reversed year to date. So if there is any kind of inflection in terms of growth and some of these companies can go from slightly negative growth to slightly positive growth, I think that's going to help the re-rating potential quite a lot. Also for other sectors that might benefit from any kind of recovery in terms of the long end, in terms of CGB yields. So the Chinese government is doing a reverse yield curve control, trying to make the yield curve to move up. If that succeeds, then I think insurance is another sector that will benefit hugely off a very, very low base of expectations.
This is a broader question, but obviously there's been a lot of downward pressure given by the policies of common prosperity, where inequality seems to be a bigger threat than poverty now in China. People are getting their salaries cut at SOE brokerages, at state-owned enterprise financial firms. There seems to be a bit of a crackdown on the financial sector. I guess in relation to the strategic national security assets in advanced technology, which is a much longer horizon. How do you play this kind of overall theme?
Look, I think the adjustments in the financial sector have been going on for some time. The anti-corruption drive is nothing new to this year. It started a couple of years ago and probably going to be the new normal, right? It's not necessarily a cycle. In terms of internet and a lot of what's been implemented there on anti-monopoly, et cetera, that also is not a new story. So if anything, on the margin, some of these regulatory pressures are probably peaking out or actually going to ease off, right? Not that they're no longer going to be important, but that the incremental effects to the companies will be less versus what we had seen previously. So I think it's that second derivative of change that's going to be more important in terms of driving asset prices going forward. So I wouldn't look at that element as an incremental negative, but really stable or possibly an incremental positive to asset prices if we're kind of more or less done for the time being.
I want to broaden out a little bit in just what you look at in terms of opportunities here right now, given that right now we're starting this easing cycle in the Fed. The AI trade, obviously people are still wondering, does it still have legs? How are you looking at some of these risk assets now?
Look, I think for the AI trade specifically, it's been made very clear by the FANG that they're at risk of underspending, not overspending, even though they've adjusted CapEx up by 25% and 20-something billion dollars on an absolute basis since the beginning of this year. So I think that, in terms of the overall orders for the NVIDIAs and so on, probably we have decent visibility for the next couple of years, but it's just a matter of valuations and, where the market is on that. But in terms of the earnings expectations, I think for FANG and so on, I think that's actually a bigger risk because clearly, if the economy in the U.S. starts to slow down, then advertising and all these things are going to suffer. So their revenue could decelerate more than expected off a high base of expectations. But on the other hand, their CapEx is pretty fixed, right? So that's what they've made very clear. So we're relatively speaking more positive on, the CapEx beneficiaries and more cautious and worried about the people who are spending big time with unclear ROI over the medium to longer term.
What's your top-line view on Hong Kong, fairly quickly? I mean, obviously, they had the big $4 billion IPO with Medea. The pipeline seems to be a little healthier than it's been in many years. What's your outlook?
I think for Hong Kong, the biggest benefit is the rate cut. That's going to help a lot in terms of the pressures in the property segment. But Hong Kong is still going to be very much linked to China in terms of, consumer confidence, in terms of any buyers coming down from China on the property market, and also financial market in general. I don't think things are going to get a lot worse given the very, very low base of expectations. But whether we have a major rebound or not, I think is going to be still dependent on China.
National Day help? The holiday spending, consumption?
It hasn't been as big of a factor as what we had seen previously. Maybe a lot of people will go to Japan or Europe before the currency strengthens further.
All right. Helen Zhu, Managing Director and CIO at NF Trinity, joining us here in our Hong Kong studios. Take a look when it comes to that pre-market in Hong Kong, of course, that reopen, and how they're going to react, of course, to this big, deeper cut that was not really quite expected here. Hong Kong, though, we're seeing slight downside here, about 0.1%. Futures are pretty flat as well in China. We have plenty more ahead. This is Bloomberg. All right, we're coming back from that holiday in Hong Kong, and yeah, still a bit of confusion, I guess, across what we heard from the Fed with this. Was it dovish? Was it hawkish sort of cut here? Certainly there was 50 basis points, but a lot of uncertainty that was injected by the Fed chair about what and where rates are going to lie here. HS Tech, though, we're slightly higher, but yeah, we're just being nice here. Flat for H shares. The property index, that's a key one that might benefit from these outsized cuts. Not doing a whole lot here this morning as well. And certainly we're watching very closely what these developers look like. Is this going to be welcome relief? We're going to get a little bit more from our Bloomberg Intelligence's Patrick Wong. They're out with a report here. Could turn the corner, they say, when it comes to Hong Kong home prices next year on these rate cuts. Not quite seeing that here today. Sun Kai property is down just slightly, about 0.5%. Keep in mind, though, we're also watching how does the banks, how are they going to react to their lending rates? HSBC, we might hear that in just a few hours as well. You're watching the China Show. The Open is next. This is Bloomberg.
Here's the headline. Fed cuts interest rates by 50 basis points, and the bond market returns are going to be negative today.
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about.
The market's going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually a steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
We would have liked to have seen the median dot for the end of next year somewhere around 2.75% to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you 250 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good.
So our guest reacting to the Fed's 50 basis point rate cut there. Yeah, of course, Bill Dudley did call it early. One of the ones that said that 50 basis points was the call for September. And you're seeing markets, at least when it comes to stocks, we're taking things in stride in China here this morning. Obviously, we've been talking a little bit more about what goes on with Hong Kong when they reopen. But take a look at when it comes to Chinese CGB yields, though. That rally continues for another day. China's 10-year yield, we're down another basis points. We're talking about 202 levels here right now. We're watching very closely what happens with some of these large caps. Not that much movement here today when it comes to what we've been seeing. But really, it's looking at the Hong Kong reopen, coming back from that holiday. And there was a lot of upside leading up to that holiday about, are we going to see some more policy come through, given just how weak the data has been. Right now, we're trading pretty flat when it comes to the Hang Seng. It really is about the Fed story here today. Tech's catching a slight bid here today. Property, there you go. That's where you see maybe one of the key beneficiaries of this Fed 50 basis point cut as well. We're seeing upside about 0.4% for that gauge in particular. And we're watching very closely what happens with dollar honky, just given what we saw HKMA following through with that 0.5 percentage point cut as well. HSBC very much in focus. We talked about how they might follow through with these Fed rate cuts, right? So they might be announcing later on today their best lending rate following that HKMA decision. So it could be, if they cut, the first policy easing from HSBC since 2019. Here's how the property developers are doing here right now. It's a pretty mixed picture here, with Wharf down some 2%. Sanongkai is slightly higher, so is Henderson Land as well. So not seeing a clear picture here. I think that is sort of the consensus that came out of this Fed, that was, we don't really know what holds, right? It seems like Jay Powell stressed in this press conference that this is not going to be, don't get used to this, right? 50 basis points could be just one and done. Right. They're watching this very closely as well. SK Hynix, Steve, that's a big one we're watching very closely as well. Take a look at the drop that we're seeing in Seoul here right now. We dropped as much as 10%. There you go. We continue that. Morgan Stanley out with a pretty bold call, downgrading the chip maker stock and cut that price target by half. They said due to pricing concerns. So that price target now cut to 120,000 won. That was from 260,000. They say Hynix looks cheap on valuation with sustained competitiveness in HBM. However, they have concerns. DRAM pricing power is fading, NAND excesses are building, and our channel checks have led us to turn more cautious than the market on all commodity DRAM segments for the fourth quarter.
Going to be watching this one. We're also watching, of course, the Australian employment numbers. They're out higher than expected for a fourth consecutive month. 47,500 new jobs added in August. After that, large number that we saw in July of 58,200. The consensus was for 26,000, and Bloomberg Economics, Yvonne, actually expected 15,000 rise. So a considerable beat there. And the unemployment rate, which was expected, at least by Bloomberg Economics, to tick upwards a little bit to 4.3%, stayed steady at 4.2%. Part-time employment change, 50,000 additional, and the participation rate in the economy holding steady at 67.1. We'll see how that reflects in the RBA cash rate target decision next Tuesday.
Yeah, you're watching how the Aussie is doing here right now, and it's basically just falling like a rock, despite this being a pretty big beat when it comes to the employment numbers. Perhaps a lot of this was because it was from part-time jobs that were added, 50,600. Actually, full-time employment actually was minus 3,000 jobs or so. So certainly this might be just something that was driven by part-time employment. We'll see how that plays out for the RBA when they meet as well. But it's really brings us back to the only game in town today, the Fed lowering its benchmark interest rate by that aggressive half percentage point to bolster the U.S. labor market. However, JPMorgan's asset management's chief investment officer says the decision was still slightly less dovish than he expected. Bob Michael also tells Bloomberg they're keeping a close eye on credit spreads following that decision.
It hit on pretty much everything we were looking for, probably a little less dovish than we thought in two instances. One, there was a dissent, so it wasn't a slam dunk, and we would have liked to have seen the median dot for the end of next year somewhere around 2.75% to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
Bob, which bond series or individual bond provides the most information right now? Is it a real yield? Is it the nominal full faith and credit? What's of the most value to Bob Michael right now?
Credit spreads. Credit spreads will tell us whether investors believe the economy is in dire shape and this was an emergency 50 basis point cut, or whether this is just a Fed a long way from neutral, perhaps, as Mohammed hinted, a meeting or two away from where they should have started the cycle, so they're starting to get towards neutral. All is well.
Okay, all is well. And yet what we saw earlier this morning was an increase in mortgage applications. What we've seen is already the bond market pricing in all of this and then some, and basically this statement only encourages that even more. Do you not see a risk of potentially reignited inflation, Bob, that we could potentially see expressed in the long end? As Mohammed was mentioning, we are seeing that yield curve steepening in a way that hints that something else is amiss, especially when paired with gold.
Whoa, whoa, whoa. We're a long way away from that. We're looking at the 3-month annualized rate of core PCE running at 1.7%. So that's not inflationary. There's signs of disinflation everywhere. When you look at the labor market, they talked about full employment. Well, The low in unemployment was 3.4%. A couple months ago, it was 4.3%. That's up 0.9%. You only see that when there's threat of recession. That's characteristic of that. They've highlighted to us that the neutral Fed funds rate is somewhere around 3%. That's a debate we could have for a long time, but it's nowhere near 5.25%, 5.5%. So they can start taking pressure off of businesses and households without reigniting inflation.
That was JPMorgan Asset Management Chief Investment Officer Bob Michael speaking with Bloomberg's Tom Keene and Lisa Abramowitz. Check in when it comes to FX. Certainly, we're watching very closely with these dollar moves. And really what we saw initially when it came to dollar yen in particular. So we saw a bit of a drop and then we spiked up a little bit here. We're talking about 143 for dollar yen now. So seeing some weakness of more than 1% for the Japanese currency. That's why you're seeing Nikkei do so well here today. So the dollar is in some ways catching a more of a slight bid in the Asia session here today, except for the Aussie, of course, after those jobs numbers. Let's look at the impact on currencies with Bloomberg Intelligence Chief Asia FX and rate strategist Stephen Tsui. What do you make of this whipsaw we're seeing across markets during this Fed meeting?
I think the U.S. dollar recovery is somewhat expected. Two reasons. Firstly, because the outcome, the Powell statement is actually slightly more hawkish as people have taken it, basically saying that 50 bips is just probably one and done. They're going to cut quota from here. So that probably sort of like spur the dollar to recover a little bit. Yeah. The second reason might just be like profit taking, so sell the Fed. So they've been waiting for 50, the Fed gave them 50, so now they'll take a break. We have the U.S. elections November, so who knows what's going to happen, right? So just some profit taking from here.
Then what do you see for the dollar going into next year, since the uncertainty is there now with this dovishly hawkish pivot by the Fed? What does that mean for the dollar? We see the initial reaction. Obviously, the dollar is strengthening, particularly against the yen. What do you see, though, into next year?
I think the rate cut pricing is still a little bit excessive because the market is pricing in like a Fed fund rate below 2.9% by the end of next year. And we all know that from the dot yesterday, the Fed actually lifted their forecast for the terminal rate at 2.9. So there could still be some room or leeway for market to readjust. So probably some consolidation, some rebound in the dollar. But as we all know, in every Fed cut cycle, whether it's U.S. rates or U.S. dollar, you just go in receivers, you just sell and rally for the dollar.
Asia FX, though, we've seen certainly a lot of relief. Yes. Leading up to this, what do we expect it now for the fourth quarter? I
mean, usually during a dollar downtrend, we look for low yielders. So we like the Thai baht, we like the Sing dollar, we like Taiwan dollar, we like South Korean won. And actually, quite interestingly, this year, the two underperformers has been South Korean won and also Taiwan dollar. So if you want to sort of like catch up, to play catch-up play for a weaker dollar, I think these tools are one of the big opportunities going forward.
What about the yen? I mean, we have the BOJ tomorrow. Obviously, the yen carry unwound. It kind of stalled at 142 or thereabouts. It touched 139, but now back to nearly 144. What's the outlook?
I think the trend will be unchanged. Now, you can see that, as you said, the yen rally has stalled because if you look at positioning now, we are talking about net longs in yens at the share of 40%, which is quite high. Historically, usually when you reach 60, 70%, the yen sort of like reverse. So now positioning is not in favor of a dollar, of yen rally, against the dollar. But we know that BOJ is very likely to hike further, if not tomorrow in October. So the rate differential, the monetary policy differential will still be in favor of the yen going forward.
All right. Bloomberg Intelligence Chief Asia FX and rate strategist Stephen Tsui, thanks so much. Plenty more ahead. Obviously, this is Bloomberg. And welcome back to the China Show. Well, Bloomberg sources say Volkswagen and its Chinese partner, SAIC, are considering closing down one of their factories in Nanjing as soon as next year amid weak sales. Let's bring in our Asia transport reporter, Linda Liu. Tell us more about this. We know that the internal combustion engine market in China is declining at the expense of EVs. We know Volkswagen is having trouble. What does this reflect about the overall market?
So this plant they're considering shutting down is in Nanjing, and it produces the Volkswagen Passat sedan as well as the Skoda brand. And it had a capacity of up to 360,000 a year. And the fact that Volkswagen is considering closing this plant just shows how much pressure they're facing in the China market with all of this capacity that's not being used. So last year, their annual production capacity stood at about 3.1 million for China. That's down actually nearly 25% from a peak in 2018 when they produced more than 4 million a year. So the tide in the China market does not bode well for Volkswagen.
Is it in any way related to what we heard from Volkswagen about them planning closures in plants in Germany, for example?
I think this shows globally Volkswagen's performance is really facing headwinds with economic pressures as well as slowing demand. So obviously in China, there's a lot of electrification, competitive pressures. You've got local champions like BYD, which has overtaken Volkswagen to be the best-selling brand. Overseas, in Europe, in Volkswagen's home market, the car sales is also very slow. It hasn't recovered to pre-pandemic levels, which led Volkswagen to make this historic decision to close factories in Germany.
Well, how does this factor in with the fact that the EU and China are sort of talking about the level of tariffs on those EVs? And to the second part of that question, does this really show how far Volkswagen has fallen from its height as being the #1 foreign automaker for many years, along with GM in China?
I think Volkswagen's dilemmas is also reflected for a lot of other foreign brands that's competing in China. Like you said, GM is also coming under a lot of pressure. Their sales have also been slumping in the China market. In the wider context of this EU EV tariffs discussion, Volkswagen and its home country, Germany, is facing a really complicated situation in that they are actually against introducing the EV tariffs because China is their single biggest market, and they don't want to escalate a trade war that's going to hurt it in China and potentially hurt it in Europe.
All right, Linda, thank you. Our transport reporter, Linda Liu, joining us here right now. And it brings us to sort of what we've been talking a little bit more about here is how, the professional life of Chinese people certainly has been shifting quite a bit here. President Xi Jinping's decision to reshape the world's second largest economy has really upended the lives of many ambitious Chinese professionals. High-paying industries, including finance, consumer technology, and property, are now out of favor. That's our big take here today. I want to bring in our senior global business reporter, Wan Ha. She's joining us here right now. There seems to be this policy shift by the government to focus on more high-quality growth. How do you think that's impacted sectors that don't align with that priority?
Yeah, that's so true. I mean, we've seen President Xi Jinping really prioritize high-quality growth industries. We're talking about EVs, batteries, solar panels, right? And at the same time, the industries that were responsible for a lot of what they called super fast growth brought in a lot of foreign investment, but at the same time was also contributing to a lot of that wealth inequality that the Chinese government are really unhappy about. Those industries have been reined in, right? So we're talking finance, internet, property. I mean, it's hard to say how many people have been affected, but potentially it's millions because the numbers are so hard to get out of China.
It's a great story. I encourage everybody to read it. And one person was quoting that they're in the garbage time of history right now. If you're in the finance sector, and I've talked to a lot of people in the finance sector up in China, they're demoralized right now because they thought they were in an industry that was being encouraged. But it looks as though the policies of Xi Jinping are saying inequality is a bigger risk than poverty.
That's right. And of course, if you're stuck, if you're stuck in these jobs, I mean, it can be very, as you said, very demoralizing, right? I mean, the people that we've spoken to, that Bloomberg has spoken to, I mean, in these sectors, impacted sectors, I mean, they've reported like lives that have been significantly downsized, right? I mean, Porsches have been traded in for bicycles. They've cut back on luxury goods spending, even dining out. They're worried that they can't afford, tuition at international schools for their kids. It may be difficult to feel sorry for these people, but at the same time, these were the hallmarks of professional success in China just a few years ago. And now they feel like the rug has been pulled out from under them, right? They're in their mid-career journeys. What are they supposed to do without a plan to transition them to other industries?
What about the sectors that are benefiting from the policy tailwinds, EVs, batteries, solar panels, as you mentioned? will there be enough jobs there to offset some of the reining in of these other sectors that you mentioned?
That's a great question. I mean, Bloomberg Economics estimates that the proportion of GDP that those industries, the new high-quality growth industries that she wants to focus on, that they're supposed to be, growing to about nearly a quarter of GDP. And of course, on top of that, you've got the tech industry, high-tech industry, chip semiconductor making. That's supposed to, bring in about 19% of GDP. So that will shore up the losses. But of course, there's that existential question, right? If you're affected, you're among the most ambitious, brightest of the country's citizenry. What happens to you when you feel, that your contributions professionally don't matter anymore and you've had your dreams dashed?
Yvonne Hall, thanks so much. Great story. I do encourage everyone to read that. And you can read the full story on today's Big Take by turning over to the terminal or by heading to Bloomberg.com. Plenty more ahead. This is Bloomberg. And welcome back. You're watching the China Show. Back to our top story and that 50 basis point cut by the U.S. Fed. Bloomberg opinion columnist Bill Dudley says he expects another rate cut in November. The former New York Fed president also told us the central bank has successfully delivered a message today that 50 basis point move was based on good news, not bad.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you do 50 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good. We've made progress on inflation, as opposed to we're doing this because the news is bad. So I thought it was a very, he's providing reassurance to people that the Fed thinks that they've got it. Also, when he's asked about, the Somm rule and the risk that the unemployment rate could go up by quite a bit more, pretty reassuring on that. Thinks that the labor market can stabilize close to where we are today, and that's really hugely important because, if the labor market doesn't stabilize, then we will have a mild recession, and then the Fed will have to ease a lot more. So I thought the general tone of the press conference and the statement was, we've got that. We've got it.
Bill, congratulations. Your essay today, you'd think you were one of the Fed whisperers everybody's talking about out there right now. Bill Dudley, I look at where we are and where we're heading, and it simply comes down to the strength of the American economy. Forgetting about the theater of recession, where does GDP settle? Whether real GDP or nominal GDP, how do you envision that in a year or even 2 years?
I think if you look at the Fed's forecast and look at how that growth affects the unemployment rate, the Fed thinks that, growth in the medium term is going to be 2% plus at an annual average rate. So, and that's sort of what we're doing right now. So, the Fed's got a sort of soft landing in place. If the economy continues to grow at the same pace as it's doing right now, the unemployment rate will stay relatively stable. You saw in the summary of economic projections, the Fed shows a very modest further increase in the unemployment rate from 4.2 today to 4.4%, but nothing beyond that. So it's sort of a soft, if you look at their forecast, it's a soft landing kind of story, and I hope they could pull it off.
And that was Bloomberg Opinion's Bill Dudley, the former New York Fed governor, also speaking with our colleague Tom Keene. Another check of these markets here, of course, and we continue to see a bit of faltering when it comes to this bond market, and we're really seeing that play out when it comes to some of these G10 sort of names here. Take a look at the New Zealand 10-year yield is up some 10 basis points, so still a bit of confusion about where rates are really going to be at the end of this after that 50 basis point cut. Outsized move from the Fed as well. Chinese 10-year yields are going the opposite direction. We're down for an eighth straight day for CGB yields. We're at 202 levels here for the Chinese 10-year yield right now. Yen as well, we continue to see weakness across the board when it comes to the yen here. So we were weakening as much as 1% or more. There you go. So initially we saw that drop in dollar yen after the statement, then press briefing came through, and there you go. We're seeing dollar yen spike higher here, there. So dollar is actually catching a bid here across most of Asia FX here today. Gold stocks are certainly in focus after it reached that all-time high, a fresh new record for gold. But again, we are retreating just slightly here this morning. But there you go. It's enough to help some of these. Oh, this is actually Bitcoin stocks as well, given what we've been seeing when it comes to Bitcoin. We're watching very closely how that plays out, given it is a risk asset. And really, it seems like for now, they are reacting more positively to that Fed cut. There you go. There's the gold miners there. They're actually heading lower after we see gold steady after hitting that record as well. The benchmarks in China looking like this, with Hong Kong coming back from that reopen. And I think right now we're really focusing on what's been going on. Not a whole lot. It seems like we're still seeing a down arrow story for the CSI 300. Hang Seng is pretty much flat. So is MSCI China here today. HS Tech seems to be reversing some of the earlier gains as well. CGB seem to be still bid up quite closely here. So certainly that's one to watch. We still have a Bank of England decision coming through later on today. There's a Taiwan rate decision as well. Keep in mind also Jakarta markets are opening up as well. And of course, still reacting to that surprise cut from Bank Indonesia before that Fed cut yesterday.
Well, we speak exclusively with the New Zealand Prime Minister, Christopher Luxon, tomorrow as the economy faces another recession. Join us for that conversation on the Times on your screen. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI a half hour into the session here right now. And yeah, we're seeing a little bit of better here, just slight upside here when it comes to the Hang Seng. Of course, keep in mind the property index. That's really where we're seeing the gains here right now. So probably the sector to watch after that Fed came through with a surprise 50 basis point cut overnight as well. So does that bring some relief finally to these developers that need to catch a break here in some ways? We're certainly seeing that here today. In terms of the overall market check, we're watching very closely what really goes on with some of the whipsaw we saw across markets from what the Fed, the statement, and then what happened in the presser with Jay Powell signaling basically that the 50 basis point cut may not be a trend, right? So there you go. SK Hynix, we're watching that one very closely. Morgan Stanley slashing that price target by half, talking about pricing concerns. So we're seeing that movement there in Seoul. But the rest of the region is doing this here right now. It seems like there is a bit of a confusion, particularly in the bond market that continues here for another day. You're seeing basically, despite that half-point move, you are seeing bond yields actually tick higher here today. FX, the dollar is actually catching a bid as well. We saw dollar yen at one point slightly drop, but then basically when Jay Powell started speaking, we are now seeing dollar yen weakening more than 1% as well. So that's sending the dollar a little bit more a flight here this morning. You're watching very closely as well. Keep in mind Taiwan comes up with their policy decision later on, BOE later on as well. Indonesia yesterday came out with a 25 basis point cut even before the Fed decision as well. So there you go. You're seeing the Jakarta come online there, the JCI up some 0.6%, Steve.
Well, Yvonne, let's hear from Fed Chair Jerome Powell speaking after the decision.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. A broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
And what does this mean for your money? Certainly that's one thing we've been checking when it comes to this MLI Pulse survey that came out just shortly after that Fed decision, right? So it looks like right now stocks could be the big winner after that 50 basis point cut from the Fed. That's according to our survey taken right after the decision. For more, let's bring in Garfield Reynolds. He's joining us from Sydney, and he leads our Markets Live coverage in Asia. So those that want to chase this rally in stocks, I mean, it seems like that's still intact in some ways, Garfield, but this also looks like a market that could be more sensitive to the growth concerns moving forward as well.
Yeah, Yvonne, there's a cautious feeling that it's worth chasing this rally. A lot of it depends on how convinced you are that the Fed is correct when it's saying the economy is in a good place and we are doing this in order to make sure it stays in a good place. So the soft landing remains in play, but there are plenty of concerns, I think, for equity investors when they look at the way that rates traders are still pricing for a lot more cuts to come. And if that sort of pace is what the Fed ends up delivering, then the concern would be that that's only because the economy has broken down. If you think the Fed did get things right, that this 50 basis points is going to help to avoid a hard landing, and that also the Fed will, if it needs, act sufficiently to avoid a hard landing, then the plan is chase the stocks rally, but be careful about it.
Right. Hey, Garfield, obviously the other central banks that have decisions coming up soon will have their own data dependence, obviously. But does this change the equation at all for the Bank of England, for Taiwan, for the BOJ and the RBA next week?
Well, I think for the BOE and for Taiwan, not so much. I'm not sure almost anything the Fed would have done would have changed things too much there. For the BOJ, I think this is a real bonus because although the Fed cut by 50 basis points, it was sufficiently undovish. I wouldn't say it was hawkish, but it's not really dovish, that the yen has dropped. Dollar yen's up about 1% or so today. It's moving well away from that 141 to 140 level, which is seen as a danger. It's even a weak enough reading for the yen to encourage the BOJ to keep rate hikes on the table there and to feel that it can do that without it setting off too strong a gain in the yen and therefore too much pain in its local markets. For the RBA, along with today's solidly unexciting jobs data, this makes things a lot easier. They can go on being concerned about the need to keep inflation vigilance without worrying that that's going to set off any extreme gains in the Australian dollar that might overly tighten policy, and it might even cool down some of the concerns that have been raised that it's been keeping rates too high for too long. So the RBA will face a fairly straightforward meeting when it gathers next week.
Garfield, thank you. Garfield Reynolds there, who leads our Markets Live coverage in Asia. I take a look at what the dots are suggesting. That's probably where you're seeing a bit of head scratching here this morning, because it was a 50 basis point cut. But we're still talking about that narrow majority that is in favor of another 50 basis point cut for the next two policy meetings this year. The market, though, they're pricing as aggressive another 70 basis points of cuts as well. That's probably why you're seeing this bond market reverse a lot of the gains after, of course, what we've been seeing, this relentless rally in bonds, of course. So what does that tell you about where the Fed and their thinking is here right now? Let's bring in Gordon Tsui, Managing Director and Head of Fixed Income at Ping An of China Asset Management, Hong Kong. Gordon, it's always great to have you. The fact that we had 50 basis points, how surprised are you?
In fact, it is a game time decision. In fact, before the FOMC meeting, yesterday at about this time, the market is still pricing in about 56% chance only of a 50 basis point cut. So, in fact, I think Powell has done a very good job nurturing a very kind of open-ended kind of scenario for committee members to debate openly and express their views. Obviously, I think Powell's own reaction function is to be more cautionary. Looking at the employment data, he would just do his best, do his utmost to nurture that perhaps the Fed should do something to ensure a soft landing scenario.
Well, Gordon, last time you were here in April, I think you said no cuts from the Fed before the presidential election. What has changed in your estimation?
This is a great question. Thank you, Steve. I think, in fact, that view was right only until the first presidential debate back in the last week of June. And at that time, in fact, the market actually feared that the Republicans can do a clean sweep of both the presidency and both houses. And in fact, bond yields, shot up, and people were just expecting that perhaps, the fiscal policy, the trade policy, tariff, everything will be, pointing to a higher bond yield, at least in the long end of the yield curve. But interestingly, in fact, the bond prices reacted in different ways during the first 2 weeks of July. In fact, the 10-year went up to 4.5%, but it dropped all the way down to the 4% psychological level in 2 weeks' time. In fact, at that time, we helped our clients to sharply extend the duration and capture the down move, which fell to 3.6% in the 10-year over the past week.
So the key question with the bond market now is, where do you think rates are going to land after the dust settles finally?
I think, in fact, I always say it is okay to be wrong, but it is just unacceptable to stay wrong. And actually, that is what we tend to practice, in this cycle. And I think right now, in fact, it is quite interesting because usually in the U.S., in Europe, it is the Labor Day holiday, in the first week of, September, that the big asset owners, the big insurance companies came back from their holiday and make decisions. I think most of them are now, long bonds, long durations. They may not have too much dry powder to add further. But now that the FOMC meeting is past us, I think it is going to be thinking about what is the implication of the election again. Because after all, it is the chance of Trump, versus Camilla that we should think about whether we are going to need to hedge on interest rates going back up again. In fact, now it is like a 40% chance or 45% chance of Trump still having not a non-zero chance.
But the
win.
equation has changed dramatically since that first debate, with Biden stumbling through that debate. And it was, as you alluded to, it was almost a foregone conclusion, perhaps, the Republicans would have a sweep. The dynamic has changed quite considerably. How much does the move by the Fed today going to play into the election, which is coming up very shortly, November 4th?
In fact, right now, as Yvonne mentioned, the end-of-year dot plot is still, a bit less than what the market is implying. Market is staying at 4.1%, right? While the dot plot is 4.375%, 4.4, rounding up. So on a probability kind of, calculation, there is still too much pricing in of interest rate cuts, at least not too much for this year. But until the end of 2025, there is just too much uncertainty. So why not grab the chance, for example, in the 30-year, 4%-ish? Is it a good position to do some hedge and short the futures? I think that it is.
Okay, so you think that we could see quite a bit of reversal in these yields? How much upside do you think?
I think it is a kind of probability-weighted scenario. Well, I still remember on the 5th of August, the sell-off in the Nikkei 50. In fact, 30-year, at that time, the low was only 4.01%.
Yeah.
And then it actually bounced back. And if we all look at the, the probable fiscal scenario and potential, kind of trade policy, not just from the Trump. In fact, the Biden administration was not particularly friendly, to other, trading partners. Well, perhaps we should price in a bit of inflation that can come from this more tighter kind of, trade relationship with other countries.
You expect a soft landing, though, by these steps? And what would be the terminal rate you see perhaps next year?
I think that the Fed has done a very good job to safeguard, to ensure that a soft landing scenario is at least the base case before the election, at least. Because after all, if there is anything, worsening in the labor market data, obviously they can do another 50 basis point. A GTD in a basketball, acronym, right?
Game time decision.
Yeah, game time decision. So they can do another 50 basis point if needed. But on the other hand, it's the case that perhaps it can nurture a very positive kind of optimism in the bond market as well. And actually, this usually reflects in a steeper yield curve.
What do you look for in terms of what is an accurate way of in the bond market, what's pricing in the economic conditions right now? Do I look at credit spreads, for example? Because that hasn't really shown that much in terms of recession concerns here right now. Is that still an accurate indicator out there?
I think we should look at the absolute kind of yield level when, considering the credit spread, whether it is wide or not. Well, on a total return basis, I think 5 to 6-ish kind of a level for corporate bonds, I think that is very attractive. In fact, if I have parked too much in the short-end money market funds, I will definitely move to the belly of the curve, 5 to 7 year. It will not suffer too much from, an expansion in, fiscal deficit or, and also a revival in inflation rate due to, trade tensions.
Well, inflation is an interesting one, too, because a lot of people we've been talking to say inflation's the lesser of the concerns right now. It's about employment. We all know that Jay Powell is going to be looking at data dependency going forward for any more cuts. Is it about the labor market?
I think the labor market is definitely the key consideration for Trump's for Powell's trying to push the committee to that side of the 50 basis point. Because after all, I think obviously U.S. economy is so strong, right? And in fact, I woke up this morning looking at through the presser. In fact, he reiterated that there is no weakness for whatsoever that raised the concern. So in fact, inflation, well, it is still not yet at target. They point at 2.7% core, in the SEP in the coming year or so. So in fact, there's still job to be done. But they just want to make sure, for example, some small and medium-sized companies, the cohort of corporate America that borrow about 85% of their loans are floating rates. They may want to lessen it a bit. Well, obviously, 50 basis points is not that much, but it starts the trend. If there is some kind of unemployment tensions coming from this sector, they can also ease further and loosen their burden.
Gordon, thanks for your insights. Appreciate you coming in this morning.
Thank you, Steve.
All right, Gordon Tsui, Managing Director, Head of Fixed Income at Ping An of China Asset Management, HK. And coming up, the trail of exploding pagers in Lebanon is traced to Taiwan and Hungary as Israel declares a new phase in the Middle East conflict. Details coming up next. This is Bloomberg.
What I can tell you is we were not involved in yesterday's incidents or today's in any way, and I don't have anything more to share. It's too soon to know if what happened over the last couple of days is going to have any effect on where we are with the ceasefire deal. Sadly, we aren't any closer to that now than we were even a week ago. So it's difficult to see any immediate impact of these incidents. But I think it's just too soon to know in general.
Obviously, the logic of making all these devices explode, indication that this event confirms that there is a serious risk of a dramatic escalation in Lebanon, and everything must be done to avoid that escalation.
Well, U.S. National Security Advisor John Kirby and UN Secretary General Antonio Guterres speaking about the attacks in Lebanon using exploding pagers and walkie-talkies. And the trail of exploding pagers has been traced back to a post office box in Budapest, as well as a Taiwanese company that licensed production of these devices. Gold Apollo's chairman says he doesn't understand how this company has become involved in what he calls the stain of a political terror incident. Well, let's bring in Asia senior editor Bill Ferries. He joins us now with more. This is a convoluted, very interesting, fascinating story tracing back to a post office box outskirts of Budapest. What's the latest, Bill?
Right, Stephen. So the earlier reports out of Lebanon were that these pagers were all manufactured by the same company. It was linked to a Taiwanese company called Gold Apollo. Once we got reporters down there, the chairman was out speaking and said that he had been contacted by a foreign company known as BAC Consulting that traced back to Budapest, Hungary, and that they had licensed this material, these pagers for manufacturing. I was part of a group that was looking into BAC yesterday afternoon, and there were a lot of just kind of red flags for us in terms of what they said their business was and what was going on. We don't know a whole lot more, but so far more than 20 people have been killed in these explosions. There was a subsequent round of explosions of walkie-talkies. I'm not sure who the manufacturer was of those devices, but it has been a big shakeup and a big wake-up call for Hezbollah. And as you've mentioned already earlier in the broadcast, Israel is signaling very clearly that they're starting to shift some of their focus and some of their troop levels to the northern border with Lebanon to potentially start a second larger phase of this conflict that's gone on for almost a year now.
Yeah, they're talking about this new phase in this conflict, Bill. I'm just wondering, I mean, how they were able to orchestrate all this is one thing, but what are some of the key questions? I mean, what was the intent from Israel in all of this in some ways? And also, what do you think the response from Hezbollah is going to be?
Well, the big question is is Israel just trying to send a warning shot here to Hezbollah? They've been trading, Hezbollah and the Israeli military have been trading fire across that border almost on a daily basis since just after that Hamas attack on Israel October 7th last year. Is this the start of something new, or is it a warning to Hezbollah to back down? We don't yet know yet. Israel's leadership, including Prime Minister Benjamin Netanyahu, has made clear that they want the 70,000 or so Israeli citizens and residents who used to live in the northern part of the country to be able to return to their homes there. That would require a de-escalation in the hostilities. Israel seeming to signal that it's willing to make that happen by force if necessary. The other big question, as you mentioned, how will Hezbollah respond and how will Iran respond? Their ambassador to Lebanon was among the many people, the many thousands of people injured in the explosion of the pagers yesterday. Will they also decide to make a big response? That's also looming out there at this point.
Bill, thank you. Bill Ferry is our Asia senior editor joining us out of Singapore. One other story that we're tracking for you, China is going to be also removing its zero tariff policy on 34 agricultural imports from Taiwan starting this month. The finance ministry says the move is in response to what it calls the island's discriminatory restrictive measures imposed on Chinese exports. It adds to tensions between Beijing and Taipei that have mounted since May when Lai Ching-te took over as Taiwan's president. We got plenty more ahead. This is Bloomberg. All right, we're still assessing really what this means, this 50 basis point cut from the Fed, and what it means for risk assets. Stocks, at least in some ways, really reacting quite positively as well. You take a look at what's been really driving that. It's really the Nikkei, thanks to that weaker yen as well. We're seeing upside about 2.5% in Tokyo. But really, look at the CSI 300 as well. That's a 1% gain. It's quite rare when it comes to the onshore market here. Hang Seng is also recovering quite a bit as well. Dollar is stronger across the board in Asia FX here today, and bonds continue to falter here this morning. Take a look at the New Zealand 10-year. We're up some 11 basis points as well. Most commodities, though, are catching a slight bit. You take a look at iron ore in Singapore, it's up about 1%. So, it seems like in some ways the market is feeling a little bit more confident, that the Fed is more confident that they stuck to this soft landing scenario here right now. U.S. futures are still punching a slightly higher here. We also have that BOE decision to count down to as well. This is what Hong Kong benchmarks are doing here right now. So quite a bit of recovery in the last few minutes or so. In fact, you're seeing that we're hitting close to that maybe 17,800 level for the Hang Seng as well. Tech, there you go. We're seeing upsized gains about 2% here. And it's the property gauge as well, the property developers that are doing quite well. Also watching China property stocks as well. After what we saw with the onshore session, these are some of the 8 share listed ones are following through here today as well. 11:29 a.m. in Tokyo. Japanese markets heading to that lunch break. And, we're seeing here quite a rally underway in Japan. We're up about 2% for the Nikkei as well as the topics here this morning. And it is that dollar-yen story that really is driving equities higher here. Take a look at that. We're at 143 levels for the yen here right now. So quite a bit of weakness there and quite a bit of reversal from what we saw in the last few hours after that Fed decision came through as well. JGB yields also following what we've been seeing here with treasuries as well as what we're seeing here in Asia, up some 2 basis points this morning as well. In terms of the market dashboard, stocks are certainly catching a bid here, and we're gaining a bit more momentum actually as we start to see things open up a little bit more. U.S. futures are also up about 0.75%, despite really what we saw, right? So we saw basically stocks head to that all-time high and then retreated and actually wiped out more than 1% of gains during that presser. Now we're seeing U.S. futures are actually turning around a bit here. The dollar also turning around here a bit as well. So in terms of sector by sector, what really is gaining here today, we talked about property. That certainly is a key beneficiary of these bigger cuts from the Fed here as well. And HKMA, following through this morning too, Steve.
Yeah, without surprise, obviously, given what the Fed did. The Hong Kong Monetary Authority has cut its base interest rate for the first time since 2020, moving as it usually does in lockstep with the Fed because of the peg to the U.S. dollar. That could help support the city's struggling property market. Bloomberg Intelligence senior APAC real estate analyst Patrick Wong is here. So we're seeing initial impact from this. It's not the panacea to the woes of the property market here in Hong Kong, but it'll go a little bit to alleviate those concerns at the developers, right?
That's true. I think now we want some positive catalyst to support the struggling market here. And definitely it's a great opportunity for developers side to sell more units. Especially, I think the housing market here, we see the price already coming down to 8-year low level, right, which is really challenging. And for developers side, I think lots of them like Sun Hung Kai or New World, they have lots of units available for sales over the next couple of months. So definitely is something hopefully will be a positive catalyst. And the challenge, of course, for short term, right, the mortgage rate may still stick here because Hong Kong didn't follow US too much in terms of the interest rate hike before. So it take a little bit of time to come down, maybe hopefully next year.
When you look at home prices now, I think we're at an 8-year low in Hong Kong. Rents, though, are going up. So you're seeing quite a bit of a divergence here. Are we likely to see that divergence continue, or do you think home prices could actually recover?
I think it takes a little bit time to turn around the thing, but you see the rent is going up, right? So last year, even this year, is something like 5%, 6% increase for every year. That is also a good sign that we see the demand is there. Just people...
No one wants to buy.
Yeah, they just wait a little bit because the interest rate is so high, right? So they wait, right, until the interest rate will come down, and then potentially it makes sense. And also for some investment demand, right? The treasury yield you see is now 3.7%, and then your rental yield is going up a bit, right, from like 2.5 to now is for mass units is 3.6%, right? So potentially we see the rental yield is going higher than the treasury yield. That could also boost the investment demand.
In the commercial space, I mean, the anecdotal evidence that I've been hearing in places like SAIC and elsewhere is that a lot of these landlords, if you will, are underwater. They're negative equity because of the drop in the prices. They haven't been lowering the rents, and that's been causing an undue stress on the commercial market. Wouldn't you agree?
Yes, I think the retail market also struggling quite a bit, right? So that is also the reason why we see the price also coming down, and then the interest rate at high level also trigger. We didn't see much investment demand, especially for the commercial market, even office as well. So the challenge, I think, short term is still there, but hopefully the interest cost cutting, so we will benefit all the corporate as well.
Yeah, that's what I meant, retail, not necessarily commercial. Commercial, a lot of these skyscrapers are empty,
or
at least 40% are about relatively empty.
Yeah,
exactly.
Patrick, thank you. Patrick Wong there from Bloomberg Intelligence. He covers real estate for us as well. So hopefully some welcome relief for the real estate sector here in Hong Kong. Coming up, U.S. officials heading to Beijing for fresh talks on economic tensions, while China's commerce minister tackles EV tariffs in Europe. We discuss all what's ahead next. This is Bloomberg. Welcome back. Here's your China Brief. A look at what's making headlines in national newspapers and trending on social media this morning. The Fed's jumbo rate cut capturing the attention of Chinese social media today. The top trending topic on Weibo this morning, hands down, generating more than 2 million views so far, with users really discussing what this decision says about the U.S. Some posts, like this one, say that the outsized rate cut is an indication the economy is in bad shape. Another asks, is another U.S. financial crisis in the making? One comment had a more geopolitical tone to it, saying this means U.S. economic war on China has failed.
Well, meanwhile, other posts are pushing back against comments critical of the U.S. Quote, "You make it sound like China's economy is doing so great." And the Post says the Fed could benefit the Chinese economy, saying China will cut its own rates, bringing down borrowing costs for businesses and boosting fund flows into local markets.
Yeah, well, as far as the official media is concerned, the Fed's policy shift won't have a significant impact on China. Ahead of that rate decision, the Global Times tabloid published an opinion piece saying that China's economy will remain resilient despite external monetary adjustments. Now, it cites domestic consumption, technological innovation, and reform and opening up.
And looking at the financial press now, the Security Times reports on the A-share holdings of China's so-called national team, which has frequently stepped in to support the struggling market. Citing its own data, the paper says the holdings have reached a 5-year high of more than 3 trillion yuan, or around $420 billion. It says the team continued to buy A-shares in the second half, with some 220 billion yuan flowing into the CSI 300 index ETFs.
And Chinese state media has extensive coverage of Commerce Minister Wang Wentao's talks with European officials on EV tariffs. For more, let's bring in our China correspondent Min Min Lo, who has been tracking these talks. How are things going? What are we hearing, Min Min?
Yeah, so this is a last-ditch effort by the Trade Minister Wang Wentao to try to prevent any sort of trade war from happening as a result of this tariff, because the deadline is September 25th. That's next week. That's when the EU members are voting on the final tariffs that will kick in November. So he made a whirlwind trip to Europe. He's been to Germany. He's been to Italy. He's in Brussels today to meet with the European Commission's trade commissioner. And he had fair warning for Germany as well when he met with the officials there on Tuesday. He said that Germany, he hopes they will act in their own interests because the tariffs will seriously interfere with trade and investment cooperation. So the subtext here is that China is really leaning heavily on Germany to try to get the EU to reverse that decision. And we know that the Spanish Prime Minister visited China not too long ago, surprising many people by breaking ranks with the EU, calling on the bloc to rethink those tariffs. And here we can really feel the tension ratcheting up, because Chinese state-linked media Global Times published a scathing editorial saying that the European Commission's attitude of ignoring, resisting and rejecting China's efforts makes us wonder whether the European side is sincere in solving the problem. And the key here is because the Chinese companies had offered to put a price floor on the car shipments to Europe to address the concern that Chinese cars are too cheap. But the European Commission had rejected that offer, and that's really frustrating to the Chinese side. They're saying that the EU is not interested in engaging in any constructive discussion here.
Well, the U.S. and China are going to have some FaceTime starting today, I believe, in Beijing. The Undersecretary for International Affairs at the U.S. Treasury, Jay Shambaugh, will be in Beijing leading a delegation that includes some Fed officials. What can we expect from this meetings?
Yeah, well, this is just one of those regular meetings of the Economic Working Group. That's a working group that was set up after Treasury Secretary Janet Yellen met with the Chinese counterpart, Vice Premier He Lifeng. So according to U.S. officials, they're going to discuss China's economic trajectory as well as its industrial overcapacity and how that has seriously harmed U.S. firms and workers. And again, it's a working discussion. Treasury Secretary Janet Yellen is not traveling to Beijing, and it's really part of that pledge to keep up this channel of communication, even as the Biden administration continues to work to protect its own national interests here.
Min Lo, thank you. Our China correspondent there on what to expect out of these talks happening in Europe as well as in Beijing. Back to the Fed now, that conversation, and really what we're seeing across risk assets, right? So we talked about stocks are catching more of a bid here this morning. You're starting to see the dollar come back a flight, and Bitcoin as well. There you go. Following that 50 basis point cut, you're seeing a 3% gain on Bitcoin here this morning. It really has continued to edge higher. And we are now back to those 3-week highs, along with what we're seeing a jump in U.S. futures as well here. Let's bring in our tech reporter, Annabelle Drewlers, who's in Singapore. She's been covering the token conference there as well. So she's been really in depth watching these crypto markets after this Fed cut. Is the outlook looking better for crypto markets now?
I think in the shorter term, yeah, of course. I mean, as you were saying, you have that Fed cut that comes through. It starts to increase demand for more speculative assets. It's a reason why people want to invest in those as opposed to, say, money markets where you've got a fixed return. So it does, of course, increase the appeal of tokens like Bitcoin, like Ether. So it's not surprising, really, the market reaction that comes through today. Of course, what's more of the medium to longer term concern for markets is the mainstream appeal. Are we going to finally start to see a real world breakthrough and a real world application that engenders more people to buy into this narrative as well? And that's still, of course, the existential question for the industry to be answering here. It has, of course, been a big talking point at Token 2049. There were a lot of bulls on the ground at the event this week, but really a lot of focus now on the US election and the sorts of policies and the focus on policies that we see as a result.
Well, Annabelle, obviously, the U.S. election you just mentioned is being discussed. I mean, we've heard about Donald Trump saying that the U.S. should be a crypto leader. Whether he's getting a bit in his ear from Elon Musk, we don't know. But again, how much of it is being discussed there, in particular, from your guest that you had, Jeremy Allaire?
Well, it's no question, really, that former President Trump is seen as someone who's a lot more friendly to the crypto industry. And so, of course, he is attracting quite broad support from that. Just yesterday, he was, for instance, at a bar buying people drinks, buying people hamburgers, and really making sort of support. This was at a bar in New York overnight, but making more of a support to or a branch of support to people that are in the community. Is that going to be something that sort of creates a problem for him? Well, we've actually just been seeing Haslinda Amin, our colleague at the Token 2049 Summit today, talking on a panel about regulation. And, for instance, we're hearing that Donald Trump is quite a polarizing person. Harris, for instance, could actually be able to get more bipartisan support for crypto regulation to be pushed through. But certainly that focus on bipartisan support is sort of what Circle echoed as well. You can listen to this interview with the CEO, Jeremy Allaire.
In the U.S., we have to get through this presidential election, obviously, and I think there's rhetoric about pro crypto or being pro business entrepreneurship innovation, which is sort of the language we're hearing from the Harris campaign. But on the ground, when you go actually look at the work that's been done, the Payment Stablecoin Act, which is the primary legislative vehicle, it's very nonpartisan. It's got strong support from Democrats, Republicans, and so I think that's going to be a piece of legislation that moves. And the rest of the world is waiting on the United States to put its rule book down and say digital dollars that are privately issued that work as money in the financial system. Here's the framework. Let's go.
Just quickly, of course, you're in Singapore, and there's sort of four main crypto hubs we can think of within Asia: Singapore, Hong Kong, Tokyo, and Seoul as well. Where do you think you're seeing the most progress right now on the stablecoin front?
Well, right now, in terms of regulation, Japan is far ahead. They're far ahead of any country in the world, in fact. Almost 2 years ago, they put in place, over a year ago, I should say, they put in place their stablecoin laws. It's very thoughtful. It creates a way for foreign issued stablecoins like USDC to be able to function there. And we've made some announcements about our intentions and what we're planning to do with bringing USDC to Japan under the regulatory regime they've established. So just narrowly for our business, like Japan is sort of has moved ahead. But both Hong Kong and Singapore are very actively working on this. There's frameworks that have been out for consultation that are going to legislative drafting, and so I don't know if it's a race or whatever, but there's real effort there, but more broadly, Singapore continues to make a lot of progress in licensing and attracting a lot of firms globally, and I know the industry broadly is excited to see what emerges with Hong Kong, who's now obviously been granting more licenses and trying to continue to support this agenda.
So that was Jeremy Allaire speaking there from Circle and really talking as well, not just about that push for regulation that comes through in the US, but what we're seeing from other markets as well. And Japan, which is a country, and we're already seeing companies like Sony, for instance, joining that call to push for looser regulation. But Jeremy also saying to me off camera that he really thinks that 2025 is when you do start to see really the idea of stable coins becoming a lot more mainstream. But of course, mainstream appeal, that is what the entire cryptocurrency industry needs to continue its sort of survival and reason to be.
All right, Annabelle Drewlers, our Bloomberg tech reporter from Singapore. Plenty more ahead. This is the China Show, and of course, this is Bloomberg.
Well, the Fed, of course, lowering that benchmark interest rate by that aggressive 50 basis point to bolster and defend the economy and the U.S. labor market. However, we did speak with JPMorgan Asset Management CIO. He says the decision was still slightly less dovish than he expected. Bob Michael also tells Bloomberg that they're keeping a close eye on credit spreads following that rate decision.
It hit on pretty much everything we were looking for, probably a little less dovish than we thought in two instances. One, there was a dissent, so it wasn't a slam dunk, and we would have liked to have seen the median dot for the end of next year somewhere around 2.75% to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
Bob, which bond series or individual bond provides the most information right now? Is it a real yield? Is it the nominal full faith and credit? What's of the most value to Bob Michael right now?
Credit spreads. Credit spreads will tell us whether investors believe the economy is in dire shape and this was an emergency 50 basis point cut, or whether this is just a Fed a long way from neutral, perhaps, as Mohammed hinted, a meeting or two away from where they should have started the cycle, so they're starting to get towards neutral. All is well.
Okay, all is well. And yet what we saw earlier this morning was an increase in mortgage applications. What we've seen is already the bond market pricing in all of this and then some, and basically this statement only encourages that even more. Do you not see a risk of potentially reignited inflation, Bob, that we could potentially see expressed in the long end? As Mohammed was mentioning, we are seeing that yield curve steepening in a way that hints that something else is amiss, especially when paired with gold.
Whoa, whoa, whoa. We're a long way away from that. We're looking at the 3-month annualized rate of core PCE running at 1.7%. So that's not inflationary. There's signs of disinflation everywhere. When you look at the labor market, they talked about full employment. Well, the low in unemployment was 3.4%. A couple months ago, it was 4.3%. That's up 0.9%. You only see that when there's threat of recession. That's characteristic of that. They've highlighted to us that the neutral Fed funds rate is somewhere around 3%. That's a debate we could have for a long time, but it's nowhere near 5.25%, 5.5%. So they can start taking pressure off of businesses and households without reigniting inflation.
Bob Michael there, JPMorgan Asset Management CIO, speaking with Bloomberg's Tom Keene and Lisa Abramowitz. We're not quite done yet, right? We got through the Fed. We still got the BOE coming up later on here today. Alongside that, Norway, Turkey, Taiwan here in the Asia Pacific. But I think the big one, Steve, is going to be the BOJ tomorrow.
Yeah, that's right. I mean, they're already meeting right now. Thursday and Friday get a decision. No rate hike is expected. But again, there was that big reaction after they hiked the last time. And we saw the unwinding of that yen carry trade, the yen strengthening, earlier this week to 139 and change to the dollar. It has since weakened back to, 143 and change, nearly 144 as that hawkishly dovish or dovishly hawkish cut from the Fed overnight, and also just kind of those expectations from the BOJ that they are not necessarily going to hike again. But the key will be, what tone does Governor Ueda set?
Yeah, and you got to wonder, the fact that this was, this Fed decision was maybe minimally, dovish, but also hawkish. You got to wonder what that means for the BOJ, right? The fact that we're seeing this weakness in the yen, does that give them more room to maybe hike rates? maybe sooner or later. But I don't know, right?
Potentially, that's why we're seeing some, stocks in Japan go up. The stocks came down considerably the last time, obviously, after the BOJ hiked for the first time in a long, long time.
Yeah.
So a little bit of a reprieve for Japanese equities, but the yen holding right around that 143 and change.
Yeah, because people say it's really about the rate differentials, right? If it's not really so much what the BOJ is going to do, it's more about the data moving forward from the U.S., right? I think we have 2 more jobs reports until that next Fed meeting. If we start to see some signs of more, I guess, cooling of this labor market, does that reinvigorate this sort of yen trade once again? That certainly is one thing that people are maybe a little bit more worried about as well. But
yeah, and we'll just have to see what the data also Governor Ueda is looking at. They've had some wage gains obviously built in, but again, they're not going to be aggressively hiking at this anytime soon.
Yeah, and also we're taking a look at what goes on with the weather. I mean, we talk about
another typhoon.
Shanghai, another one.
We talked about it earlier this week about the typhoon that hit earlier this week over the weekend was a bullet typhoon that comes straight in off the ocean into rather than curling up the coast, goes straight into Shanghai. We have another one, and I'm just looking at, if you go to either StormGo or even MapGo and then click on the right on your Bloomberg terminal to cyclones, you can see the latest storm that is being threatening Shanghai. In fact, after hitting Naha, Okinawa yesterday, it has turned northwardly and now heading directly towards Shanghai. And guess who's heading to Shanghai tomorrow?
Mr. Steve Engle again.
A couple of storms heading into Shanghai.
All right. Stay dry, stay safe. You take a look when it comes to markets. And speaking of that, what does this mean for the whole travel sector in China? Certainly you're seeing a rally here underway. This is after what we saw with some of the consumption data that came out after this Mid-Autumn Festival, and actually looking pretty upbeat. But does it actually defy some of the weakness and concerns about the economy and, of course, this consumption story that continues to be deteriorating as well? At least we're seeing some upside. Citi had an interesting call. Solid trend in October, they say, to sustain until the National Day holiday in October.
Yeah, I mean, we just had a holiday, the Mid-Autumn Festival. There was a bit of a tick up in consumption, but the week-long holiday, will it move the needle at all on property purchases, on big-ticket items? I think given the state of the economy, most people say probably not.
All right, risk assets are a flight here this morning after the Fed. That's it for us here in the China Show. Bloomberg Markets Asia is next.